Venture capital has been credited with funding more than half of all US public companies in the last few decades, including almost every major tech giant from Amazon to Google to Facebook. But how do venture capitalists actually know what's the next Google or Facebook? There's this romanticized ideal of a venture capitalist savant who's got a crystal ball that can see into the future, or who can stare into the whites of the founder's eyes and soul read if they're going to be the next Steve Jobs. In this video, I'm going to give you the real picture of how VCs diligence and pick their investments, which is very different, but much more fascinating than the notion that it's 100% unexplainable genius. Let's get started. Silicon Valley is full of legends in the VC world, but even among them, John Doerr stands out as arguably one of, if not the most storied investor. He ran the iconic firm Kleiner Perkins, where I interned and am definitely biased, but his body of work is indisputable. First lead investor and board member at Google, Amazon, Genentech, and companies like Netscape, Compaq, and Sun Microsystems. He's the only investor to appear on the Forbes Midas list of top venture capitalists every year for the past 2 decades. And yet, even he's human. It's widely publicized now that John led a number of high-profile clean tech bets, deploying hundreds of millions of dollars in companies that didn't work out. This is not to pick on John, but just to underscore that even the best in the business have a hard time recognizing great companies consistently. To give you a better idea of exactly how difficult this is, let's rewind to the early days of Google. Here's Larry and Sergey as Stanford PhDs who famously started the company working out of a garage. This was the initial landing page for Google, which looks kind of like 1990s clip art that maybe your kid could do. Would you pick this product as a future trillion-dollar company? What about Apple? Here's the two Steves working together out of their parents' home on the first Apple prototype, which was actually originally for a school competition. Even the original Facebook was little more than a sparse college online directory to creep on classmates. When they first get launched, everything starts off looking like a toy. In fact, figuring out what is a great investment in the early days is so hard that if you look at the data, failure is the norm and not success. Cambridge Associates estimates almost 100% of the returns from startups in any given year come from just a handful of the thousands that are funded. So we're talking about a 1 to 2% hit rate here. At the best firms, it's maybe double that, so say 3 to 4%. And you'd think with all these failures that VCs would be more humble. Just to nail this point home, I'll give you some stats on what a typical VC investing funnel looks like at the early stage. Let's take an average fund with 2 partners. They may see about 10,000 deals a year. Inbound emails, demo day lists, warm referrals, companies they maybe do some research on. They maybe meet, say 1,000 per year, so 500 per partner, which is 10 meetings per week. Out of those, they might invest in only say 2 to 5 each, a total of say 5 to 10 companies for the entire year. If you don't have an effective process for handling all of that volume and whittling it down to just the best companies you see each year, you're screwed. If you're just throwing darts, the chances of you investing in the best company you see is like 0.1%. You have to be able to effectively triage, pick the companies that you want to dig in deeper, identify the key risks, and make hard decisions with really limited information. Okay, so let's get into how a VC picks deals. A VC is going to be looking at 5 things in every startup deal. As an investor, you can think of startups as having layers of risk that get peeled off over time. First, is this the best team for the market? Does it feel like they're destined to solve this particular problem? Can they execute to build their vision of the future, recruit others to join the cause, and scale to a massive company? The team is hugely important, and arguably at the early stages, the single most important factor, because ideas can always change, but the core team can't. Second, is the market big and attractive? Is there a wave in the market that the founders can ride? Some of the biggest outcomes happen when the ground is shifting underneath the feet of the market, opening up opportunities for new startups. Can the team build something that can drive mainstream usage beyond early adopters? Often, companies enter a market with a very sharp, narrow wedge that's pretty niche, and the question is whether they can broaden from there to adjacencies that are bigger markets. On that note, third is whether the team's unique approach is going to win in this market. Will their product be 10 times better than the alternatives? In many of the best companies, this takes the form of a counterintuitive secret that no one else knows or believes because it sounds too crazy. And let's say the startup succeeds. Who are the incumbents and how are they going to respond, if at all? Oftentimes, there's a race for the startup to build distribution and scale before the incumbent can innovate. Fourth, how well is everything actually working? What's the revenue, product usage, retention, unit economics, and all the other signs that this founder's thesis for world domination is actually playing out? And finally, you have to look at the deal setup. Is it a good risk return at the company valuation in terms that's being considered? And does the round setup, the ownership, and the check size make sense for the fund? So that's the framework that VCs use to assess companies. How could you possibly know enough about every distant corner of technology and markets, from quantum computing to social networks? There's absolutely some pattern recognition you develop over time as you meet thousands of companies, but it's impossible to know everything. So that's why you run what's called a diligence process. Be forewarned, we're about to go deep. Here's how it works. It starts by deconstructing an investment into its unique risk factors, consistent with the framework that we just went through, and honing in on the key questions that you want to answer. Could be questions like whether a competitor is going to push out a better product to market, or whether there's enough potential users to build a big business, or testing whether some contrarian opinion from the founder is possibly true. Unless you're somehow an expert in the field, it's helpful to find somebody who can act as sort of a Sherpa through the process. Sometimes that could be a fellow VC at your fund, or it could be somebody within your extended network. They'll inevitably flag a bunch of initial questions for you to start interrogating, and then be a sounding board for you throughout the rest of the process. What comes next is translating that initial list of questions into a work plan to go answer them. Here's the most common ways to do that. So let's say the founding team is an unknown quantity to you. You don't know them, and maybe they don't have a track record because they're first-time founders. In that case, assessing the team might arguably be the most important yet subjective part of your diligence process. You might think it's pretty simple. You spend time with the founder and just hope you're blown away by the brilliance of the next Steve Jobs.
There's an old Wayne Gretzky quote that I love. I skate to where the puck is going to be, not where it has been.
But if you only cared about charisma and the first impression someone leaves you, you definitely have missed this guy, who famously was painfully shy and said next to nothing in early pitch meetings for Facebook. I found it's helpful to borrow best practices from recruiting and hiring people generally. Studies have shown interviews can be a really noisy signal for whether somebody's going to be good at their job, so it's becoming increasingly common to rely more on references and to not just focus on assessing surface level skills, but more foundational attributes. I think there are definitely valuable lessons here for evaluating founders. Founding a high-tech startup is insanely difficult, maybe the most challenging business endeavor I can think of. And it requires, on the one hand, extreme grit to power through inevitable troughs, uncanny learning agility in wearing multiple hats as a founder and iterating quickly, a deep obsession to solve big problems, and of course, a willingness to take risks. If someone has these qualities, even if they've never had a job before, you will find evidence of that in their personal lives. One of the founders we backed at Signalfire, Moya, is the epitome of this. His home burnt down when he was in high school, and his family was left homeless. He developed a passion for fitness, working out at a free gym, taught himself online on Khan Academy, graduated early, and then put himself through a Columbia computer science degree by becoming a physical trainer. He naturally started a fitness company and paid himself poverty wages, living on food stamps while supporting a family in the extremely expensive Bay Area for almost 5 years before raising a large venture round. Now, that company Tempo has become one of the leading home fitness products and has raised hundreds of millions of dollars to democratize access to physical trainers. Even in just that short story, you can see how all the founder attributes I mentioned come together in a way where it feels like Moya is destined to build that company and solve that problem. As a general principle, when you're assessing founders, it's really helpful to see what people have done, not what they've said. If someone says they're excited to take on the risk of a startup, but they've never gone off the beaten path in their careers or their life at all, and were straight down the middle of the fairway lifers at some big company, then their actions say something different. References can also be really helpful in teasing out whether founders acted entrepreneurial in the workplace. So it's important when you do references not to listen to the tone of the reference, which can often be negative for founders, but the substance behind it. Oftentimes, you'll hear a great founder was very sharp and creative and got a lot done themselves, but didn't play nice well with others, was opinionated, and ultimately wasn't happy with the speed at which the company moved. That's a very common mixed review about somebody at a big company who might make a great entrepreneur. Okay, so now to test a founder's take on a market, it's pretty common to set up calls with industry experts. But just like founder reference calls, make sure you focus not on the tone, but the substance. Oftentimes people who've been in the same industry for years and years become rooted to the way things are, and they might lack the imagination for a completely different way of doing things. That's why innovators are often outsiders to the industries that they disrupt. Uber was built not by the taxicab industry, but by a UCLA dropout. Airbnb was dreamed up not by the hotel industry, but by a designer. That designer was Brian Chesky, and he came upon this problem almost by accident. He really needed cash one day, so he rented out his sofa and got dozens of responses on Craigslist. What he realized was there's this massive undersupply of hotels during peak periods like big conferences. But people really only stuck to hotels because they trusted them. The magic insight he had was that you can actually replicate that trust through reviews and ratings, which unlocks a huge supply of unused rooms in people's homes. To test those sorts of unique insights, sometimes you as a VC can do your own primary research beyond just talking to experts. Besides putting up your own property for rent on Craigslist, you can also do market surveys or other more creative ways to get your own data. In 2015, Signalfire met Frame.io, a company that builds workflow for media creatives to collaborate on videos. At the time, the product was mostly being used by just amateurs and prosumers, and we honestly had questions about how large the addressable market was. We ended up doing a LinkedIn search for people who self-describe themselves as video creatives and whether they worked independently or inside big media companies. And what we were surprised by was just how fast the number of media creatives was growing, but inside new digital media companies like BuzzFeed, Vice, Snapchat, as they were all starting to push out more short-form content that required more frequent collaboration. That gave us more conviction that Frame could ride that wave up market. And luckily, that story has a happy ending. Frame got major traction within even large media companies and recently sold to Adobe for $1.3 billion. Market sizing is actually a notoriously hard thing to get right because it's just tricky to predict what parts of a market are actually open for a startup. In a lot of cases, if a company completely dominates a strategic niche, they can often have an unfair advantage in extending into other valuable adjacencies. And companies can get a lot bigger than you'd imagine. Amazon famously started by selling books online, but eventually became the definitive e-commerce engine that also happens to run the internet today with AWS. The later stage you play as a VC, the more important it is to get the market size right. In 2009, an unknown investor, Yuri Milner, made an investment in Facebook at a $10 billion valuation, which was twice the price any other investors were willing to pay. At the time, it was seen as a ludicrous investment by an unsavvy outsider to Silicon Valley. But everyone, and probably even Yuri himself, underestimated the size of Facebook's market by several orders of magnitude. And the investment put Yuri's firm DST Global on the map. As we've learned in the past few years, when things work out, software markets are so much bigger than we can possibly imagine. When you're trying to assess the competitive dynamics, often there's just no substitute for talking directly with users of a startup's product. Understanding what a user did before discovering this product, what other products they compared it against, and how they made their choice is a great way for you to develop user empathy. But if you're only talking to active users, you might get adverse selection for early adopters. So it can be helpful to also pitch the startup's idea yourself to prospective customers who haven't used the product before. Just make sure you really feel comfortable articulating the value proposition and you've really got the right target user when you do so. A lot of startups build features that a big company could theoretically throw 50 engineers at and build in a month and squash that startup. So sometimes it's also helpful to talk with people, often former employees, at those legacy incumbents. Ideally, the startup is going after something that the incumbent thinks is a distraction, but is actually going to be a huge deal, or the incumbent has a business model conflict. Patreon, for example, filled a gap for creators to monetize superfans off-platform with subscriptions at a time when YouTube's business model revolved around ads, keeping viewers on platform. Sometimes big companies can actually be a huge asset. Instagram, for example, was strategic for Facebook, Google, and Twitter as this up-and-coming social network built around beautiful photos. And they were quickly bid to a $1 billion exit just weeks after raising their first venture money as a 15-person company. That might seem cheap now that the company's worth an estimated $100 billion inside Facebook, but the point is you can get these outsized outcomes really quickly when there are big, well-capitalized players trading at high multiples, competing against each other, and who find what a startup is doing strategic. Traction is a huge topic unto itself, and no one's really shared what good startup traction looks like publicly. I'm actually going to make a separate video that does exactly that, so check it out when it's up. There's a few common techniques for calibrating a reasonable price or valuation for a deal. One way is scenario modeling. You basically take the big risk factors you flagged in diligence and construct sensitivities around them. For example, what would happen if Frame.io stayed a prosumer company versus if they managed to cross the chasm into enterprise accounts? You can estimate probabilities for those scenarios, a company value in each case, and then calculate a weighted average return. Another simpler way is comparables. For example, if the average public market SaaS multiple is, say, 15 times revenue, you can potentially apply the same multiple to a startup as well. The big difference, though, is startups are much faster growing, sometimes tripling or more every year. So VCs often project revenue forward, say 12 months, and assign a multiple to where the company will be. Then it's sort of up to you as a VC to decide how likely the company is to hit their numbers in a year and when you're going to be in the money, so to speak. All that said, Figuring out the right price is often more an art than a science, especially at the early stages. Obviously, if you pay a 2 times higher price, mathematically your returns are going to be cut in half. So clearly price matters on some level. But if you bought 1% of Google, it didn't really matter if you got in when the company was valued at 100 million or a billion even. You'd still make 1,000 or 10,000 times your money. That's the incredible power law of startups that's really hard for human beings to internalize. Most VCs dream of that billion-dollar outcome, but the next Google will be worth 1,000 times more than that. That's why it's often said you need to look for amazing deals at reasonable prices and not reasonable deals at amazing prices. And there's more to a deal than just the price. In fact, the round setup often just doesn't work for a fund's economic model. For example, a multi-billion-dollar fund may not want to bother with $1 million check size. It's just too small to move the needle. On the other hand, if you're a small $10 million fund and you can only write $100,000 checks, investing in a company at $1 billion valuation is going to give you 0.01% of the company. And that's not going to move the needle for you either. Or a fund may be looking to build a concentrated portfolio with minimum ownership of 25%, and there may just not be enough room in the round for that. Okay, so now you've done all the work, and it's time to make a call on whether to invest. VCs typically summarize their diligence in what's called an investment memo, and then send that for reading to all the partners at the fund. Then each partner usually scores companies on a scale from say 1 to 10 along the 5 dimensions, team, market, competition, traction, deal, and then come up with an overall score and a recommendation of whether to invest or not. A lot of judgment comes in just how you weigh different criteria. In a pure execution-oriented market, maybe the team matters even more than typical. On the other hand, if a company has a unique insight to be a first mover with strong network effects, then maybe it's okay if the team has some gaps. Twitter was famous in the early days for their fail whale and having poor engineering. But because the company had such strong momentum as a social network, frankly, their growth made up for a lot of problems, and they could attract really strong engineers over time. Once you have all the votes on a deal from all the partners at the fund, there's another layer of decision-making theory that goes into figuring out what to do from there. A firm like Sequoia designed their decision-making to be consensus-driven, so all the general partners have to agree for a deal to happen. Whereas a firm like Kleiner Perkins, at least when I was there, was much more individual-driven. Votes were given to the partner who was leading diligence for the deal as feedback to consider, but it was ultimately up to that partner to decide whether or not to invest. My personal opinion on this is that the earlier stage you go, the crazier ideas look and the less money is at risk. So you really need to give latitude to individual partners to develop conviction and pound the table. But at the later stages, when you're risking tens or hundreds of millions of dollars, it's helpful to be more consensus-driven to avoid burning huge holes in your pocket. There's this really interesting notion that the best companies are very controversial and have divided votes within a partnership. And I do believe a lot of transformational company ideas, they start off looking like toys or sounding absolutely crazy. Can you imagine what Elon Musk's first pitch must have sounded like to build cars with huge expensive electric batteries in them, or to send people to outer space? At the end of the day, even with the best of intentions, no venture firm has designed a foolproof process that recognizes outliers like that. Every VC I know, including really successful ones, has an anti-portfolio larger than they care to admit, and probably larger than their actual portfolio. Diligence can't possibly factor in all possible future scenarios. FedEx almost went bankrupt multiple times and benefited from union strikes at competitors. No one could have predicted any of that. Fact is stranger than fiction sometimes. But what diligence can do is lower your failure rate and give you the best chance of partnering with incredible founders and companies. VCs like to play up this myth that they can see into the future. This feeds into the idea that venture is something where you just have the gift or you don't. And it has the effect of keeping the VC world small and clubby, less diverse, and the domain of the few who just happen to have a track record. I hope for outsiders, this video will help demystify the process of picking the next Google or Facebook. I think the reality is lots of people can be amazing VCs, and they're those who can more clearly see the present and allow themselves to dream alongside the best founders who are really the ones inventing the future. If you like this video, give me a thumbs up and subscribe so I get some feedback on what to create. Thanks for watching. I'll see you next time.